Let's get started. Hey, hi everyone. Thanks for joining in. It's a slightly sunny Sunday here in Bangalore, and we've had some rains yesterday, so the temperature has slightly come down. So today, I wanted to discuss our small and mid cap stock model portfolios. So before we actually jump into discussing our model portfolios, I'm going to discuss a couple of things around investing in small cap companies, like what is the general trends being like, whether it's a good time or not. And then we are going to take a deep dive into two of our model portfolios that are sort of like, mid and small cap oriented. So without much ado, let's get started. So first thing, this is the agenda for today. We're going to discuss recent macro trends, and then we're going to jump into understanding what's generally been happening in the mid and small cap universe. And then we are going to go into what is Windmill's offerings in the mid and small cap arena. We're not going to look at everything. We're going to look at two small cases. We're going to do a fairly deep dive into them. The whole idea is to get you to understand, what is the approach that we have taken to these small cases. What are the nuances of these small cases? This is not an advertisement for both of these small cases, but it is certainly a educational tour of these small cases, which is why I'll not be sharing any returns, but you will sort of be able to see the relative performance with respect to a comparable index, and you'll be able to understand how the small case generally performs. And in the final session, obviously, we will be moving on to question and answers. So we have a lot of ground to cover. So let me get started. Just to start off with whatever has happened with the capex cycle so far, this is the macro trend. Now, when it comes to capex cycle, we have to move a step back and understand what exactly is this capital expenditure, which is either the expenditure by government or houses or private companies going into. This goes into forming gross fixed capital, right? Now, gross fixed capital refers to any amount of roads that you are building in the country, any amount of bridges that you are building in the country, airports being built, ports being built, and these kind of fixed infrastructure. So obviously, as you can see, the gross fixed capital formation has been as a percentage of GDP. The gross fixed capital formation number has sort of been trending up since March 2021. The formation in March 2021 was 31% of GDP. Subsequently, it increased to 32.7% and then 34%. And during the first half of 2024, which is between April and September 24, it has reached 35%. The numbers for the next part, which is October to April 24, the numbers are not yet out, but the expectation is it is going to be a higher number compared to the 34% that was recorded at end of March 23, right? So now there are a couple of different things that contributes to this gross fixed capital formation. One is whatever is the expenditure by the government. So one easiest thing to look at is what is the number of how many thousand kilometers of roads are being built, how many thousand kilometers of railway tracks are being laid out, what is the amount of money being spent towards building airports and ports and all of these kinds of hard infrastructure. The second aspect that contributes to capex cycle is private capex, which are the companies which are sort of announcing capital expenditure and they are setting up factories in different parts of the country. And the final sort of aspect is the housing aspect, which is individuals like you and me buying into houses and these kinds of things is the third pillar that contributes to the capex cycle of the country. Now, let's take a quick look at each one of them. What's been happening? What's the general trend being like? So government capex, you can obviously see that, you would have already read this in the newspapers. You would have had discussions around this when budget was announced and stuff like that. Starting 2015, there's been year on year, every year, there's been a lot of increase in capex spending by the government. So in for FY24, which was year ending March 31st, 2024, the revised estimate for capex spending by, excuse me, by the central government is expected to be about 9.5 lakh crore rupees. In addition, central government has also spent about 3.2 lakh crore by giving grants to state governments to create capital assets. And obviously, you can see that there's been significant jump in numbers every single year. So lot of focus by this particular government in attempting to create capex for the country. The next part is the private capex. Now you can see that when it came to private capex, FY29 there was like 4.6 lakh crore expenditure by private companies, and then there was 4.4 lakh crore. But then COVID came about, and then we had steep drop in these capex numbers. And then it dropped down to 3.7 and then 4.8. But then subsequently, it has started raising. FY23 was a decent year. We saw 5.9 crore. And during the first half of the year, we've already seen 3.4 lakh crore. And compare this with the 3.1 lakh crore that we saw during the first half of FY23. So we are starting to see year-on-year rise here also, which is a positive thing. In terms of housing, what is the capex cycle contribution from housing, which is individuals like you and me? So you can see that bank credit for housing as a percentage of GDP has certainly started trending up since FY21. You can see that in FY21 it was 7.5%, but then it's sort of tapered off, 7.4 and 7.3. But now it has started gaining traction again. It has gone up to 8.7% in FY24, right? That's the expectation. If you look at residential sales, you can see that blue line there is the residential sales in top 7 cities, and you can see, and that is the million square feet being sold. And you can see that since about after May 23, this number has also started increasing. It has hit till November 23, the numbers were raising. And then one factor that is obviously contributing to that is mortgage rates have been pretty flattish after Reserve Bank of India sort of held on to their repo rates. The mortgage rate has been pretty flattish, and that has contributed to this increase in residential sales. Now, these are the three factors that are sort of contributing to the capex cycle of the country, which is extremely important for any sort of private company to perform well. If the government is giving out orders for building roads, if other private companies are giving out orders for making boilers and other capital expenditure items, and then there is demand coming in from the housing sector also, then private companies tend to do well. So all three of these things seem to be working in favor of private companies. Now let's jump into mid and small cap companies and understand what's generally been happening with their performance. We'll take a look at the fundamentals of these companies. We'll take a look at the price performance, valuations, and all of these things. So the first thing about mid and small cap companies is recent price performance. So the first one is Nifty 100 index, which is the large cap companies. The second and third rows are Nifty Mid-Cap 150 and Nifty Small Cap 250 index. And the last one is Nifty 500, which we could consider as proxy for the entire market. Now, you can see that over the last 1 year, if you look at the performance, the Nifty 100 index has run up about 30.3%, and the overall market is up about 36.8%. But look at what has happened to mid and small cap companies. 54.7% run up for mid cap companies and 66.4% run up for small cap companies. And on a year-to-date basis, which is January till April, the performance has sort of tapered off a little bit for everybody. But prior to that, this is what the run-up has been. And to sort of set the context, what has happened was since February 2022, right between February 2022 and March 2023, the markets were pretty flattish. It is only since March 23 that we've sort of started seeing this run up. So if you sort of compare the performance of 1 year performance with performance since start of Russia-Ukraine crisis in February 22, you can see that all of Nifty 100's performance has come in the last 1 year. Before that, it was very flattish. Same thing is happening with Nifty Mid-Cap 150 index also. Only 6% increase between February 22 and March 23, and the rest 54.7% has come in since then. Nifty Small Cap Index, in fact, 58.2% return since Feb 22 and 66% since the last 1 year, which means between Feb 22 till March 2023, the index was slightly negative. And the same trend has continued with the markets also. So this sort of gives you a understanding of how fast the markets have run up in the last 1 year. Now, what has happened because of markets running up fast? You can see that it has affected valuation. Both these charts indicate the 1 year forward PE ratio for Nifty Mid-Cap 150 index and Nifty Small Cap 250 index. You can see obviously that blue line there that has gone above the historical average number in both these instances, which means the markets are at a slightly overvalued level now. Now, since January, because the markets have stayed flat, there has been steep correction in the valuations, but they are still on the slightly expensive side. Now, let's look at what is contributing to this sort of run up, right? Is it just momentum that's sort of pushing? Is there any, logic behind the momentum that we are seeing for mid and small cap companies? Now, you can see 28th February 2022, Nifty Mid-Cap 150 index, the index value was at 10,621. The trading PE at that point in time was 26.83, and the cumulative EPS was 396. If you look at the numbers on 29th February, these are slightly dated numbers, but it will not change the picture a lot for us. The index value was at 17,831, which means 68% returns. The trading PE has not changed too much. The trading PE on February 24 is at 26.96. But look at what has happened to the earnings per share number. The earnings per share, which had gotten hit due to COVID and lack of demand and all of those things in February 22, it has jumped up to 661 by February 24. So the PE ratio has not expanded. That has remained flat since the last 2 years. But earnings have grown by about 60 to 68% in the last 2 years for Nifty Mid-Cap Index. If you look at Nifty Small Cap Index, the same thing. PE has expanded by just about 10%, but earnings have grown by 53% in the last 2 years. So whatever this momentum that we are witnessing for mid and small cap companies, there is a lot of solid earnings per share growth that is pushing it up. It is not just that, it is sort of simply momentum based without any logic to it. So that is an exceptionally good thing to happen as far as investors are concerned. Okay. Now, the next part, which is which sectors are sort of driving this earnings growth. The entire chart has been divided into 3 sectors. The first sector, auto, cement, pharmaceuticals, industries, private banks, consumer durables, and FMCG. This is where, as far as small and mid-cap companies are concerned, the earnings is growing faster than large cap companies with similar top line growth. Okay, so you can see that for auto sector, the profit after growth was 35% for large caps, whereas for small and mid cap companies, it was 61%. Similarly, for private banks, the large cap profit after tax growth was 10%, whereas for SMID companies, it was 23%. Now, the next thing, the next bucket is companies, SMID companies. SMID is small and mid cap. SMID sector companies where earnings is growing faster than large caps, and there is a significant top line improvement also. So look at PSU banks. Large cap PSU banks, the top line growth has just been about 3%, whereas in case of SMID, it is 7%. Very similarly, profit after growth for large cap PSU banks is 15%, whereas the profit after tax growth for SMID banks is 40%. Except for chemicals, everywhere else this is the trend. And there are certain sectors like infrastructure, paints, energy, and stuff like that, where the profit after tax growth is largely in line with what has been happening with large caps or slightly poor. So that has been happening in infrastructure, paints, financial services, consumer services, and energy companies. So you can see that there are a whole host of opportunities available to us, like auto, cement, pharmaceuticals, metals and mining, PSU banks, IT, telecom, where small and mid cap companies are doing much better than their large cap peers, right? So now that is one part on the earnings side. Another important part is on the gearing ratio. Gearing ratio is nothing but a net debt to equity ratio. Now you can see what has happened to the net debt to equity ratio at a cumulative level. What has happened to the net debt to equity ratio for Nifty small cap 250 companies? You can see that till FY15, the gearing ratio, the debt to equity ratio was at 0.76. So for the uninitiated debt to the lower the net debt to equity ratio, the better, because the company then does not have to pay interest and all the earnings flow into the profit after tax, right? So, but since then you can see that the companies have been sort of deleveraging, which means the debt has been going down, and the current net debt to equity ratio of 0.3 is almost at a lowest level since FY 2009, which means these small and mid cap companies are sort of well set, wherein they have the ability to take on more debt if they have scope for capital expenditure, but at the same time whatever earnings that is coming through is directly going on into increasing the earnings per share of the company. So that is like sort of, that is how where a low gearing ratio works for these companies. So now to sort of like, put everything together, pricing, there's been a lot of price run up. So I have given it a thumbs down. Valuation has also run up slightly, though there is correction. So thumbs down for that. But what is working in favor of mid and small cap companies? Macro environment has been very good. Earnings growth prospect has been extremely positive, and balance sheet has been very healthy, right? So this is what has happened in mid and small cap group of companies. Now, it is very, before we jump into our mid and small cap model portfolios, I want to tell you about where these mid and small cap companies or portfolios should sit in an investor's overall portfolio. Now, I have told this earlier also, I have presented the same chart earlier also. There's something called a core and satellite investing, right? What happens in a core, which is two different parts of your portfolio if you're an investor. So what happens in the core portfolio? You should always hold stable and diversified investments. So what is an example of a stable investment? Investing in large cap companies, introducing a proportion of debt into your portfolio, introducing a proportion of gold into your portfolio. All of this contributes to the stability of the portfolio. So stable, and by introducing and by having large cap equities, maybe a certain proportion of debt, certain proportion of gold, you're sort of diversifying your investments. Second suggestion is you could use ETFs, whether it is large cap equity, whether it is gold, whether it is debt. There is some or the other kind of ETF that's available to you, which will allow you to easily track the market. Now, ETFs generally have low expense ratio, so they are not expensive to hold. And the whole idea behind the core of the portfolio is it should be designed in such a way that over the long run, the returns on this portfolio sort of should be stable, and it should be ideal for all market conditions, right? You should not be making exceptional amount of returns on your core portfolio, but at the same time, when there is a drawdown, when the market starts correcting, there should not be a very steep correction also. So the wealth creation journey in the core part of your portfolio has to be very, very smooth. Now, what should be happening in the satellite part of your portfolio? Now, in the satellite part of your portfolio, you should always hold specialized or focused investments. This basically what this means is you're sort of probably taking debt into this part of your portfolio, but that could be sort of like, a corporate debt paper, or you could have a lot of mid and small cap companies or portfolios in this satellite portfolio. Overall, the idea should be you're taking on, stocks or debt assets that have the potential for higher returns, but they might also be slightly on the riskier side. The overall idea with the satellite part of your portfolio is it should be used to enhance the overall portfolio returns. Here, this is what should be pushing your portfolio returns when there is a bull market, but at the same time, when there is a bear market, the drawdown might also be slightly on the higher side when compared to your core portfolio, right? So this is a framework that investors should keep in mind when they are creating their portfolios. So now, what is the best way to approach how to invest in mid and small cap companies given our entire discussion? First, given the current market situation, and you should also remember that we have an election coming up. Now, we all have our political preferences, but the opinion polls sort of talk about, most of the opinion polls sort of talk about the present government winning absolute majority. But anyone who's watched Indian politics for a long time can tell you that, these opinion polls might not always be correct. One good example of where opinion polls did not go correct was 20 years ago in 2004, when Vajpayee government was expected to win increasing number of seats, but it did not, and the UPA-1 government came into power. So it is always possible that your political what happens in politics is very, very unpredictable, and we are going to get to know about it only in June. So that's still 2.5 months away, and there are multiple sort of levels or multiple timelines at which voting is going to be held in different parts of the country. So that is certainly a risk factor that's in front of us. Given this risk factor where the current government might not be able to win absolute majority and stuff like that, time and the fact that mid and small cap companies have run up fairly, please avoid large lump sum allocation to any equity product, not just mid and small caps, any equity product. If you are over allocated to mid and small cap, my suggestion is kindly reduce it, right? If you have already set up SIPs and you have a slightly longer time frame. No, when I'm talking about longer time frame, I'm talking about 4 to 7 years. If you have a slightly longer time frame, then please go ahead and continue with your SIPs. Do not stop SIPs. And most importantly, I have not put it on the slide. Do not attempt to time the market. You will not be able to. Stop asking questions. Stop asking yourself. Stop asking any supposed expert questions like, is it a good time to invest in the market? Anytime you start is a good time to invest in the market, right? That's absolutely fine. Just make sure that the investment is not happening in lump sum. You're not overexposing yourself to mid and small caps. Better going via the SIP route and make sure to or ensure and absolutely ensure that the time frame for which you're going to invest is long term. And when I'm talking about long term, especially when it comes to small and mid caps, I'm talking about 4 to 7 years time frame, nothing below that. 4 to 7 years. Okay, so that sort of sets the context for what's been happening on the macro side, what's been happening on the mid and small cap company side. Now let's try to get into what are two of Windmill Capital's offerings here. Now, like I told you, this is not an advertisement for these small cases. This is just an educational tour as far as the small case is concerned. I'm going to talk about what has worked well in these small cases, what has not worked well in these small cases. We're going to get into a deep dive into the offerings. I'm deliberately not showing you absolute return for the small cases. You can always go onto our platform and look it up because I don't want you to be influenced by the returns. That should not be the only factor that is sort of driving your investment decision, which is why I'm deliberately not showing you the returns. There is a comparative performance that's available to you. You'll be able to see that, but no returns. Okay. So the first one, before jumping into the small case, I'm going to talk about what is our approach to sort of building a small case. We follow something called the Quantamental investing framework. So the way it works is it's a combination of quantitative as well as fundamental screening techniques. And our idea behind attempting to sort of come up with this or attempting to adopt this Quantamental investing framework is we wanted to eliminate any bias that is sort of inherent in either quantitative or just the fundamental screening framework. That's the idea. So before the way to sort of creating a model portfolio is we start with idea sourcing. So we check to see what are the factors that has worked in the Indian market. Do you think we can give exposure to pure value portfolios? Do you think we can create a combination of value and growth? So there is the idea sourcing process part, and then we move on to researching, right? Okay, value and growth is something that I'm looking at. What is the research that's available to us in an Indian context or even in a global context? Has this actually worked? What are the market conditions under which this will work? What are the conditions under which it is expected to outperform or underperform? All of these things. So once a solid idea is formed where we feel, this is possible to execute in an Indian scenario, then we go on to define our universe. Then we go on to define the exact fundamental screeners, right? And then we use these screeners to backtest. And provided we have good enough results, then we are going to implement it into the Quantamental model, right? We are going to reduce it to a model. We are going to create a small case and everything. This gets launched onto the, onto the platform. Investors will be able to invest into that particular model. And then obviously there is timely rebalancing to ensure that there is, the model retains its freshness, right? This is the approach. Now, what do we do in terms of attempting to, so here I talked about, defining a universe and creating fundamental screenings. So I'll give you an example. If I'm attempting to create value and momentum small case, my universe would be top 750 stocks, ranked by market cap. Now, once I rank these companies by market cap, will I open up my fundamental screeners to all these 750 companies and then, whatever is shortlisted, will I put that into basket? Absolutely not. There are certain other checks we have introduced in order to ensure that the safety of the investment is paramount, right? So first one is the liquidity filter. This is a proprietary filter that we have created, which basically allows us to check how easily a stock can be bought or sold. The whole idea behind ensuring stocks are bought and sold easily is that there is lower transaction cost for the investor, and the investor can enter or exit any position without causing drastic price movement. So that is one proprietary filter that we have created for ourselves. Next thing that we check is promoter holding filter. Now, what happens is a lot of times promoters would have pledged their holdings in the company with banks or other financial institutions. And what happens is when there is drastic price movement and the promoter is not able to provide enough collateral, banks or these financial institutions sort of attempt to sell away these shares and the share price starts tanking. So we have seen this, this process, destroying shareholder value over a period of time. So what we have done is we check out those companies which have high promoter holding below the level that we are comfortable with. Next thing we check out are default probability and red flag filters. So companies that have high probability of defaulting on their debt papers, their names being present in the names of these companies being present in ASM, GSM list, all of these things we check and ensure that only those companies that match all of these filters, the liquidity filter, the promoter holding filter, and then the default probability and red flag filters, that gets moved on to the screener. It is only on this truncated list we apply our fundamental screeners and then create the model. So this is to ensure that your investments are fairly safe. Now let's move on to the model itself. Yes. So first one that I'm going to talk about is value and momentum small case. If you look at the entire universe of Windmill Capital's small cases, this is one of the best performing small case in terms of returns that it has generated over the last 8 years. So the idea behind value and momentum small cases, we are looking for positive momentum stocks that are available at a discount to their peers. So if I have to simplify it a little bit, we look for companies that have a lower PE ratio compared to their peers, but at the same time, the shares of these companies should be witnessing a momentum when compared to the larger market movement. Those are the kind of companies that we are looking at over here. The minimum investment is on the higher side. It is about 1 lakh plus rupees. Obviously, this is a paid small case. You can get access to it for about by paying 3,000 rupees for every 3-month subscription. So what are some of the special characteristics of this particular small case? One, it is market cap agnostic, which means we are not specifically looking to either shortlist large caps or mid caps or small caps. But since the model filters for value as well as momentum kind of stocks, historically, we have seen that there is a lot of inflow of small and mid cap stocks into this particular small case. So usually, the small case tends to be small and mid cap heavy. And obviously, because it is small and mid cap heavy, there is extremely high volatility associated with the small case. When you go onto the app, when you are checking it out, please make sure whether it is value momentum or any other small case, please check out what is the volatility label of that particular small case, right? This is also extremely important. Along with returns, you have to be comfortable with the volatility label. And for value and momentum, the volatility label is very high because it has high exposure to mid and small cap companies. And what is the suggested holding period? The suggested holding period is long term. As I have told you earlier, long term in our lexicon means 4 to 7 years time frame, right? So this is about the small case itself. Now, what are the factors that are going into making these small case? One, there is the value factor, like I told you. The thought process behind value factor is stocks that are undervalued relative to their fundamentals, right? This is what value is all about. These stocks, the general belief behind investing in low PE stocks is people believe that there is a potential for significant price appreciation in the long run as far as low PE companies are concerned. The next factor is the momentum factor. The momentum investing in momentum factor, the general belief or the what you could say, what has been witnessed is stocks whose price has run up recently will continue to see further price rise. So that's the general idea behind investing in momentum. So with value and momentum, we are clubbing both of these two factors, value and momentum factor, and we have created a small case. Now you can see the relative price performance of this particular small case against equity multi-cap. The reason why I'm putting equity multi-cap as my comparable index is because it has few large cap stocks and a whole host of mid and small cap companies, which is why I'm putting in equity multi-cap. So you can see that significant outperformance that this small case has shown over a long period of time. Since April 2020, between June 2019 and April 2020, it was pretty flattish. But then since then, it has started outperforming. Obviously, there are long periods of flattish performance also. If you look at December 2021 till March 2023, right? The performance has been very flattish. But then it started jumping, and look at the run up. And the same thing has happened here also. Between April 2020 till December 2021, slightly after post-COVID, when the market started raising up, this small case also started trending up. But then another factor is what is the max drawdown. Now, max drawdown refers to the maximum drop that the stock has seen over a period of time. So as far as value and momentum is small case is concerned, the max drawdown is 44%, which means for every 100 rupees that you would have invested in the small case, the value that you would have lost at that level, at its lowest level, would be 44 rupees, which means if you have invested 100 rupees, that would have ended up becoming 56 rupees. Compare that with equity multi-cap. The max drawdown for equity multi-cap is 38%, 38.3%, which means if you had invested 100 rupees in that particular small case, the max drawdown that you would have, the highest loss that you would have seen is 38 rupees, and you would have still been left with about 68 rupees, whatever, right? So you can see that the max drawdown for value and momentum small case is on the higher side. Now let's look at a couple of different things that is happening below the hood for value and momentum, and also the sector exposure that the current basket gives you. It's a fairly diversified basket. You can see that a lot of 6.7%, and then there is 13.2%, which is two pharmaceutical companies, and then there are a whole host of electrical components and equipment companies, apparels and accessories, private banks, four-wheelers, auto parts, oil and gas exploration, commodity chemicals, and all of these things, right? So what is happening? What are some of the special characteristics of the small case? Since large cap stocks usually tend to be overvalued, mid and small cap stocks are self-selected in the small case. Like I told you, because we are looking at value factor, most large cap companies will not be available to you at a value, right? They will either be trading on par with their sector or slightly above the sector. It is usually mid and small cap companies which are trading below the sector PE ratio. Now, during times of market crisis, stocks of fairly valued companies do not drop too much, right? So if the PE ratio of the company is already on the lower side and the market goes into a there is a bear market, stocks of low PE companies usually tend to not go down too much, which means what happens is by having some low PE companies in your portfolio, the drawdown can sort of be minimized. And what happens is during bullish phases, momentum kicks in, because momentum is another factor to the small case. Momentum kicks in and it helps the small case beat the broader market. And like I told you, the other thing is the small case has significant risk of drawdowns when compared to the overall market, and it is suitable for long-term investors with slightly higher risk appetite. So that is something that you have to keep in mind. That is as far as value and momentum small case is concerned. Next, we have quality small cap smart beta small case. This quality small cap, here we are specifically looking at small cap companies with positive momentum trends. So the minimum investment is significantly lower for this small case. It is at 21,756 rupees. Once again, this is also a paid small case, 3,000 rupees per month. What are some of the special characteristics? It is small cap focused. We are only looking for companies which are small cap, and in India, the definition of small cap is anything that has market cap rank of more than 250, right? That is what small cap companies are. Obviously, because it is a small cap, small case, the volatility tends to be very high. Holding period is long term for this particular small case. Okay. Now, what are the three factors that we are giving you exposure with quality small cap smart beta? First one is focus on the word small cap. So there is size factor, right? Small cap companies, historically, we have seen that small cap companies usually provide greater returns compared to larger cap ones over a long period of time. The second thing is the quality factor. Now, every small cap company will not be a great opportunity to invest because they have not so mature business models and stuff like that. So within the small cap universe, investors or portfolio managers have to search for quality small cap companies. So what we have done is we have created a proprietary quality score, which sort of ranks companies on the basis of management effectiveness, financial strength, earnings quality, earnings variability, and all of these factors. So on this universe of small cap companies, we apply this quality rank, and only those companies which meet the quality rank are then checked for momentum. Momentum, we've already seen what it is. And if the company's shares have been witnessing momentum, then we add it to the small case, right? So that is how quality small cap smart beta works. Obviously, you can see that once again, quality small cap smart beta also has outperformed the comparable equity small cap universe. And the advantage here is this quality small cap smart beta has lower drawdown when compared to equity small cap universe. The reason why it has lower drawdown is because we are looking for quality companies. Now, the equity small cap universe will have all small cap companies, right? But at the same time, we are looking for quality small cap companies, which is why the drawdown is on the lower side, right? Okay, so now what is happening below the hood for this particular small case? Obviously, one, we have used the proprietary quality factor. It evaluates management effectiveness, financial strength, earnings quality, earnings variability, and all of these factors. I already told you about this. And then I told you the small case has significantly lower drawdown compared to the universe of small cap stocks. And this obviously helps steady the portfolio during times of crisis. And another thing that you have to notice with quality small cap smart beta is a lot of times what we have seen is, because we are looking at small cap universe, and then because we are looking at quality, and then because we are looking at momentum, we might not be able to find 15 stocks that meet all of these criteria on a monthly basis. In such situations where we don't have enough number of companies, what we do is we move, we introduce gold bees. And so if we have only 10 companies which meet the criteria, then for the other 50% we introduce gold bees, and this churning keeps happening. And if the next month we find enough number of companies, then the gold bees is dropped from the portfolio, and the company takes its place. So once again, a diversified set of portfolio for this one. 20% is in IT services and consulting, and then you also get exposure to FMCG, household products, software services, oil and gas refining, shipbuilding, commodity chemicals, home electronics, and all of these things. Okay, so this is as far as our small cases are concerned. Now, I think we've already started receiving some questions. I will go out to these questions and see what they are. Okay. Aman has asked, can you suggest small cases for long term? Like I told you, there are already two small cases that I have put out, value and momentum, and quality small cap smart beta. Kindly consider this. Vishwas, can I get access to all Windmill small cases at one price? Vishwas, no, you will not be able to do that. We used to have this, access to bundled plan earlier, but that based on investor feedback, we have sort of scraped that. Now you can only invest in individual small cases, and you can only buy into those small cases that you're interested in. Anubhav, can you pick specific days where one should invest instead of SIP method? Putting money on sharp correction days will help us make money. You could use something called the market mood index, Anubhav, but I would, but it's you could just Google market mood index, and you could try to time your investments on that specific day. But it is not an exact science that you'll be making exceptional amount of returns using the market mood index. It is sort of a guide to what has been happening in the market. So just check that out. If it works for you, let us know next time, right? Jyoti Arora is saying, I've invested in quant small cap for the last 5 years. For 5 years this month, do I need to worry or not? I have no idea what is quant small cap. Is it one of our small cases? Certainly not. So I don't know. I don't have any, sort of feedback on what is not our product. I want to pledge my capital. Can invest. Bulasar is saying, I want to pledge my capital. Can I invest whole money, all one or small part wise? I have no idea what you're talking about, Bulasar. Then I think we answered another question. Aman's question we've already answered. Vishwas is saying, I'm new to small case. I like Windmill's offerings, but the subscription fees is too high. Is there any option to pay fixed amount and get access to all of small cases by offerings by Windmill? Like I told Vishwas, we do not have access to that plan at all anymore. You can only buy into those small cases that you have that you are interested in investing in. Deepak, shall I stick to one small case having flexi-cap or invest in various thematic small cases? Deepak Patil is asking this question. Deepak, see, I will not be able to do it without understanding, your entire risk profile and your sort of situation. I'll not be able to give you any suggestions or recommendations. I suggest you reach out to a registered investment advisor to understand what is good for your situation. Anubhav is saying, sir, you interact and rebalance with us only quarterly. Suggest to interact more in short Q&A videos and give indications on when to buy and when to wait. Anubhav, yes, I've taken your feedback on that. We will do a slightly shorter Q&A. In fact, I would like to remind you that this is the second, AMA session that we have done in the last 1 month. I think we did one on March 17th, and it's April 21st today, and we are already talking once again. But I'll take your feedback. We'll try to do more of these interaction sessions. Shailesh Punde is saying, can you please suggest good small case for SIP with low investments? Shailesh, my suggestion is go on to the small case platform, look up Windmill Capital. You will be able to see the minimum investment amount over there. There are a whole host of small cases which are slightly low, minimum investment amount. You can check to see which one works for you, and you can start investing. Avi is saying, can I take loan to invest for long term in your value small case? I would certainly not suggest that, Avi. I would never suggest to anybody that you take loans to invest in equity products at all. That's a very, very bad idea according to me. Sharad Gaud is saying, one-time payment or every 3 months I need to pay 3,000. Every 3 months you need to pay 3,000, Sharad. Anubhav Saxena is saying, will Monday be a good day to add to bulk due to war situation? I don't know what is happening on the war end. The latest news that I heard is both Israel and Iran seem to be pulling back a little bit. Whatever is happening to the war situation, it's not like Indian markets have corrected very, very steeply or anything of that sort, Avi. I think the cues, Anubhav, the cues for us for the Indian markets are going to be what is going to happen in the upcoming election. So I would suggest please don't do any bulk additions. Please go for SIP. Pratiksha, what's yearly subscription? Can I invest now? Please suggest small case and what's minimum amount to invest? Pratik, you can go on to what is yearly subscription. Yearly subscription is when you pay, a certain amount of money each year to us as manager fees to get access to specific small cases. You could invest now if you're interested in. I just discussed 2 small cases. My suggestion is go ahead and explore that. The small cases that I discussed are simply from a educational perspective. It's not a recommendation or suggestion that you should invest in it. And what's minimum amount to invest? Minimum amount to invest is the minimum investment amount that's mentioned on the small case. You will never be able to invest lesser amount than what is already suggested. Pratik Nelge, yeah, I'm an investor in Windmill Dividend Aristocrat small case. Is it okay to hold for long term? Well, any equity product is okay to hold for long term. In this case, if you don't need the amount, I suggest you let it grow and you can hold it on for long term. BS is saying, interested to start investing with small case. I want to reach out to someone to speak personally once. You can drop in a line to support. There's no outbound call support at the moment, BS. You can drop in a line to support@windmill.capital. You will be able to find our email ID on our website, Windmill Capital's website. You can just drop in a line with all your questions and I'll reach out to you. Aman Phatak, any plans on making a small case for core portfolio? Yes, there is already all-weather investing small case, Aman. Please explore that. That's sort of a unique, one of its kind offering in the Indian market itself, not just Windmill or small case or anything of the sort. It's being created keeping in mind core portfolio preferences. So kindly explore that, and it's free to access, by the way. Happy G, is there a max amount we can invest in Windmill small cases? Max amount is totally up to you. Happy. We have not set up any sort of ceiling in terms of what is the max investment amount. Be better than yesterday. Do you manage individual portfolios on some paid charges? No, we do not manage individual portfolios. Shravan Reddy, how is rebalancing done? Is the subscriber notified and he himself has to do it? We do the rebalancing on our end, Shravan, and then we send a notification. So you will receive this notification on the small case app. You will also receive a reminder on your email ID. You can just go ahead and sort of like, push two buttons and, approve the rebalancing and it automatically gets done. Vijay Thapa is saying, I have a monthly SIP in all-weather investing and I'm targeting for 15 to 20 years. Will it be a wise decision? I certainly think so. All-weather investing, like I told you, is a core portfolio. Go in with the long term, make sure that it is part of your core investment and you should be good. I think those are most of the questions that we have received. Okay. So if you have any more questions, please drop in a line to support@windmill.capital. If you go onto our website, you will also see a contact number. If you want to, do an inbound call, please feel free to call us. And if there are any questions, I'm more than happy to answer those questions. So we've had a good 45 minutes discussion around investing in mid and small cap companies. What are our two offerings in this area? Like I told you, please treat these small case pitches as educational. They are not an advertisement for you to sort of like, go ahead and we are not suggesting or recommending that you should go ahead and invest in these small cases. And obviously, commonsensical situation, position to take is future returns might not always be proportional to what has been generated in the past, right? So that brings us to the end of our session. Thanks everyone for joining in.